This is a developing markets update. The Chicago Mercantile Exchange, known as CME, has announced another increase in margin requirements, marking the second such hike within a span of just 3 days. The first increase was implemented on January 28th. The latest increase is scheduled to take effect on Monday, February 2nd. According to the information presented, CME is once again raising maintenance margin requirements across several precious metals contracts, adding to the adjustments made only 72 hours earlier. From the margin levels established after the January 28th increase, gold margins are now being raised by an additional 33%. Silver margins are increasing by another 36%. Platinum margins are rising by 25%, while palladium margins are increasing by 14%. These adjustments are sequential and are being applied on top of the previous margin hike. The reported cost to hold a silver futures contract had already risen significantly following the initial increase, moving from approximately $25,000 before January 28th to around $66,000 afterward. With the new increase taking effect Monday, that cost is expected to rise further, according to the information shared. Alongside these margin changes, the article describes growing strain in the physical silver market. Over the past week, sourcing physical silver has reportedly become difficult to nearly impossible. A trading update posted on Saturday by Tori Personson, identified as the founder of Bullion Star, stated that it remains uncertain whether the company will be able to acquire any additional silver inventory at all. During the same period, Golden State Mint reportedly halted silver sales for the weekend, citing an inability to secure silver supply. The article notes that the last time similar conditions were observed was during the period described as the COVID panic. In the United Kingdom, Bed & Company, described as the country's largest precious metals refiner and retail dealer, has reportedly shut down online sales. These developments are presented as evidence of a growing disconnect between the physical silver market and the paper market. The article states that the physical market appears to be dislocating from paper pricing mechanisms and that Monday's market opening will be closely watched to determine whether paper pricing can hold under these conditions. The article also includes a personal disclosure from the original speaker stating that they do not sell trading signals, mentorships, memberships, or products, and that any claims to the contrary should be disregarded. It is further stated that the speaker operates only on specific platforms and is not responsible for other sources using their name. This disclosure is presented as part of the original commentary accompanying the market discussion. Turning to recent price movements, the article references a sharp decline in precious metals prices on Friday. Silver is reported to have fallen by 31% in a single day, described as the largest daily loss on record. The article states that J.P. Morgan closed 633 silver short contracts at what is described as the exact bottom of that move. This action is presented as having occurred during the same trading session. The article further connects these market movements to broader financial developments, including commentary related to Kevin Warsh and his stance as Federal Reserve Chair, described as opposing quantitative easing while supporting rate cuts alongside balance sheet reduction. According to the article, markets sold off following this perceived policy shift away from unlimited liquidity. The CME margin hikes are described as arriving immediately after this volatility and after some of the sharpest price declines observed. The official explanation for the margin increases is described as improved risk coverage. However, the article states that many traders view the timing and scale of the hikes as a deliberate effort to pressure over-leveraged long positions by increasing the cost of holding futures contracts. This sets the stage for heightened attention on the next trading session. As these developments converge, the focus now shifts toward the detailed market mechanics, international pricing disparities, and physical supply indicators that have emerged alongside the margin increases. Those elements and their reported implications for the broader precious metals market. As the margin increases approach implementation, the article shifts focus to pricing disparities emerging across global markets, particularly between paper-based exchanges and physical silver trading hubs. According to the information provided, Shanghai spot silver is currently priced at $122.13 per ounce, while the COMEX silver price stands at $85.33 per ounce. This places the Shanghai premium at $36.80, representing a premium of approximately 43.13%. These figures are presented as current market observations and are cited as evidence of a widening divergence between regional pricing mechanisms. Further illustrating this divergence, the article references pricing data from JD.com, identified as China's largest e-commerce platform. On that platform, gold bars are reportedly selling for approximately $57.20 per ounce. Physical silver bars are listed at $163.35 per ounce. When compared with U.S. COMEX pricing, this represents a premium of approximately 91% for physical silver. The article emphasizes this figure by restating that JD.com silver pricing at $163 contrasts sharply with COMEX pricing near $85. The article states that this pricing gap is now at its widest level and characterizes the difference as a fundamental disconnect. It further claims that silver pricing based on supply and demand fundamentals cited in the article would place silver near $130 per ounce. It is also stated that previous instances where silver traded at a 30% discount to fundamentals were followed by price rebounds. These observations are presented as historical references included in the original content. Attention is then directed to the concept of silver backwardation, which the article states must resolve, noting that physical silver trading at substantial premiums while paper prices decline creates an unsustainable condition. According to the article, one of the two markets must eventually realign, and the physical market is presented as signaling that paper pricing is misaligned with current supply realities. The article reinforces this point by returning to conditions in the physical supply chain. Bullion Star is again cited as reporting difficulty to near impossibility in sourcing physical silver. Golden State Mint is described as being unable to secure silver, prompting a temporary shutdown of sales. Bed & Company in the United Kingdom is reported to have shut down online sales as well. These actions are framed as occurring amid what the article describes as extreme and unprecedented physical demand. A direct quote from Bullion Star is included in the article and states that throughout this period of market revaluation, dealers have witnessed extreme and unprecedented physical demand. At the same time, replenishment options have become increasingly scarce, with physical metals drying up and mints operating under enormous backlogs. The quote further states that in such an environment of constrained supply and sustained physical demand, sharp price declines in paper markets are difficult to reconcile with the realities of the physical precious metals market. This quotation is presented verbatim as part of the original article's factual record. The article frames these conditions as part of an ongoing disconnect that has been observed throughout the week, with Monday's market opening described as a critical test of whether the disconnect can persist. The report then expands its scope to include digital asset markets, specifically referencing Bitcoin. According to the article, a prior observation had set 82 as a key level for Bitcoin over the weekend. Bitcoin is reported to have closed at 78 instead. At the time referenced in the article, Bitcoin is stated to be trading at 78. The article continues by stating that if Bitcoin does not show strength at the next market opening, a move towards 74 or lower is possible. It further states that a break below 74 would place Michael Saylor underwater, which is described as a psychological level that could trigger additional selling across cryptocurrency markets and other risk assets. These statements are presented as part of the original commentary and are included here without alteration. Finally, the article emphasizes the importance of the Asian market opening. Shanghai futures, Hong Kong markets, and Tokyo are noted as opening ahead of U.S. markets. According to the article, if Shanghai silver holds at current levels or rises while COMEX remains closed, it would indicate that physical markets are not reacting negatively to margin hikes. Conversely, if Shanghai pricing gaps lower and follows COMEX, it would suggest global selling pressure. This framing sets the stage for further examination of market reactions, institutional positioning, and broader financial implications. As the article progresses, it broadens the scope to include additional market signals and institutional behavior observed during the recent volatility. It states that approximately 75% of viewers engaging with the original content are not subscribed, a statistic mentioned in the article as part of audience engagement commentary. This is followed by a return to the central theme of contrasting realities between paper-based markets and physical asset conditions. The article outlines what it describes as two opposing market environments currently unfolding at the same time. On one side, it points to paper market activity, including the CME's decision to raise margins twice within 3 days, alongside a reported 31% decline in silver prices on Friday. It also references Kevin Warsh's policy stance as Federal Reserve Chair, which is described in the article as opposing quantitative easing while supporting rate cuts paired with balance sheet reduction. This policy framing is cited as contributing to negative sentiment toward metals and broader market sell-offs. In addition, the article states that Dow futures are down 300 points as the sell-off linked to this policy interpretation continues. It also claims that options traders are now the most bearish on the US dollar in history, a condition presented as part of the broader financial backdrop during this period of volatility. Contrasting this paper market activity, the article presents what it describes as the physical market reality. It states that silver has recorded 9 consecutive green months, which it describes as the longest winning streak in history. Gold is reported to have logged 7 straight green months, also described as the longest streak on record. At the same time, dealers are reported to be shutting down sales due to an inability to source metal, reinforcing the article's emphasis on supply constraints. The pricing disparities previously discussed are reiterated, including the Shanghai premium of approximately 43% and the JD.com premium of approximately 91% relative to U.S. COMEX prices. The article also states that China's gold imports from Russia have reached a record high, presenting this as another indicator of strong physical demand. Dealers are again cited as describing demand as extreme and unprecedented. The article then turns to geopolitical developments. It references a direct quote attributed to Iran, stating that Americans should know that if they start a war, it will be a regional war. The article further states that former U.S. President Donald Trump said he deployed troops and warships to Iran. It also notes that Qatar's foreign minister delivered a final message to Iran's supreme leader, who reportedly responded by stating that Iran would not start a war or wish to attack any country, but that its people would deliver a powerful blow to anyone who attacks them. These developments are presented as rising geopolitical tensions in the Middle East, which the article states could act as another catalyst for precious metals markets. It notes that if tensions escalate overnight or into Monday morning, safe haven flows could potentially override selling pressure caused by margin hikes, though this is framed strictly as a conditional observation included in the original article. The article then outlines two possible market scenarios described within the original content. In the first, characterized as bearish, CME margin hikes take effect on Monday, requiring traders to post significantly more capital to maintain positions. According to the article, traders unable to meet these requirements could face forced liquidation, leading to additional selling pressure in paper markets despite physical scarcity. It states that Friday's price action appeared to reflect forced liquidation rather than fundamental selling, and suggests that Monday could see similar dynamics. This bearish scenario also includes continued weakness in Bitcoin, with a potential break below 74 triggering further selling across cryptocurrencies and risk assets. The article describes a cascading effect in which Asian markets gap lower, European markets follow, and U.S. markets open weak, with selling spreading across asset classes amid margin calls and a scramble for liquidity. The article then presents an alternative scenario, described as bullish, beginning with the observation that J.P. Morgan covered short positions at the reported bottom on Friday, reducing short interest. It states that physical holders in China and India are not selling at lower prices, and that supply constraints create what the article describes as a solid floor. CME margin hikes are characterized as potentially representing a final protective move for clearing firms. It further states that if physical demand remains strong and premiums persist, the credibility of paper pricing systems could be challenged. The article reiterates that Friday's 31% drop did not break what it describes as a broader bull market, and frames the move as forced liquidation rather than a fundamental shift. Historical references to previous rebounds following deep discounts to fundamentals are again cited. As these scenarios are laid out, the article emphasizes that the coming market opening represents a decisive moment. With margin hikes, physical shortages, global pricing disparities, geopolitical tensions, and digital asset volatility all converging, the outcome remains unresolved. The article indicates that the next segment will focus on synthesizing these elements and summarizing what the coming session represents within the context of the reported developments. As the article moves toward its conclusion, it brings together the multiple forces currently converging across global markets and reiterates why the upcoming trading session is being closely watched. It states that Monday's opening represents a critical point where competing pressures from margin policy, physical supply constraints, digital asset behavior, and geopolitical developments may intersect. The article returns first to the issue of CME margin increases, emphasizing that this is the second hike within 3 days. Gold margins are rising by 33%, silver by 36%, platinum by 25%, and palladium by 14%, with the changes taking effect Monday. These increases significantly raise the capital required to maintain futures positions and are described as having the potential to force additional liquidation among traders who are unable to meet the new requirements. The article reiterates that such liquidation could continue to pressure paper prices regardless of physical supply conditions. At the same time, the article underscores the severity of physical market constraints. It again cites reports from Bullion Star indicating near impossible conditions for sourcing physical silver, along with Golden State Mint's suspension of silver sales and the shutdown of online sales by Bet & Company in the United Kingdom. These actions are presented as concrete indicators of constrained supply and sustained demand. The previously cited premiums in Shanghai and on JD.com are restated as evidence that physical pricing remains far removed from U.S. futures pricing. The article emphasizes that these conditions have produced two sharply divergent market realities. On one side is the paper market, shaped by margin hikes, sharp price declines, and forced liquidation. On the other side is the physical market, characterized by high premiums, inventory shortages, and dealer shutdowns. According to the article, Monday's opening will indicate which of these realities exerts greater influence in the near term. Bitcoin is again referenced as a parallel indicator of broader risk sentiment. The article notes that Bitcoin is trading at 78 and reiterates that a failure to show strength could increase downside risk, while a stabilization could help restore confidence across risk assets. The article stresses that Asian markets, including Shanghai, Hong Kong, and Tokyo, will open first and therefore play a key role in setting the tone before U.S. markets resume trading. Geopolitical tensions are also revisited as an unresolved variable. The article restates comments attributed to Iranian leadership regarding regional conflict, along with references to U.S. troop and naval deployments and diplomatic messaging delivered by Qatar's foreign minister. These developments are described as potential catalysts that could influence market behavior, depending on whether tensions escalate or remain contained. In drawing its final conclusions, the article highlights several core observations. It reiterates that silver and gold have recorded extended multi-month winning streaks, even after the sharp decline reported on Friday. It characterizes that decline as forced liquidation, rather than a shift in underlying physical demand. Historical references included in the article suggest that prior periods of deep discounts relative to fundamentals were followed by recoveries, though no forward-looking guarantees are stated. The article stresses that the immediate focus remains on observable data rather than speculation. Market participants are encouraged, within the context of the original commentary, to understand the risks associated with leverage, margin requirements, and volatility. It states that margin hikes can force exits regardless of long-term outlooks, and that preparation and awareness are critical in such environments. As the report closes, it reiterates that the next 24 hours are expected to clarify whether recent price action represents a final phase of liquidation or whether further pressure may emerge. The convergence of CME policy decisions, physical supply constraints, international price premiums, digital asset movements, and geopolitical developments places heightened importance on the upcoming session. This concludes the report as presented in the article. The situation remains fluid, and attention is now firmly on the opening of Asian markets and the subsequent U.S. session, where the balance between paper pricing mechanisms and physical market realities will be tested.